Dear clients, welcome to PhillipCapital Weekly Market Watch. I'm Caroline, Analyst from Phillip Securities Research. Today, I will share with you on Singapore residential market outlook. The 3Q residential market remains weak as private residential prices and sales activities continue to suffer by cooling measures and global macro uncertainties. According to URA, the 3Q14 private residential price index slid for the fourth consecutive quarter with a drop of 0.7% quarter to quarter, bringing the price 3.9% lower than the peak in 3Q13. The pace of decline, however, slowed for this quarter. The transacted volume for overall private residential market fell to 2,955 units, the second lowest quarter since 2009. This is mainly attributed to subdued demand resulted from the stringent financing regulations and the Hungry Ghost Festival, which traditionally had deterred buyers to make home purchases. Furthermore, developers had held back on new launches and focused on moving old inventories from previous launches. This led to a plunge in new launch units to 1,294 and primary sales to 1,531 units, a steep decline of 54% and 43% quarter to quarter and year on year respectively. 3Q14 recorded the lowest number of new units launched and sold since 2009. Primary sales volume for 4Q14 may inch higher with more project launches like Marina One Residence and Sophia Hills. We estimate the new sales volume to be in a range of 7,500 to 8,500 units in the whole of 2014. Similarly, the 3Q private residential rental index continued to head south of 0.8% quarter to quarter after a dip of 0.6% in the previous quarter. This is the fourth consecutive quarter of this decline. The decline is led by falling rent with the widest margin of 1.9% in core central region, while there is no change for rents in the outside central region. The vacancy rate is 7.1%, unchanged from previous quarter after rising for 5 consecutive quarters. Moving forward, the rental market will still face downward pressure with the anticipated stream of new completion and stricter foreign labor policies. For the resale market, there was a slight improvement of 0.1% and 0.4% on a monthly basis for the private residential and HDB resale index respectively in October 2014. However, this is not a signal that the market is recovering. In the latest update, the HDB resale index has declined 0.8% month to month to 137.5 for November 2014, the lowest since TSDR was introduced. The lead time to secure a deal is longer now. On average, it takes about 6 months to close a deal for condominiums and 3 months for HDB versus less than 3 months in 2013. Within the next 2 years, there will be a flood of new homes completion and it is expected that 6,000 HDB upgraders will take the keys to their BTO flats each year. Therefore, we reckon that the resale price to edge lower into 2015 as the HDB upgraders will be compelled to sell off the current units at lower price expectations. The transaction volume is expected to improve as the potential buyer will enter the market as the price falls. In summary, we feel that the residential market outlook remains challenging with cooling measures likely to stay in near term. Since 2009, the property price index rose by 60%. However, the prices has been resilient with a gradual fall of 4% since peak in 2Q13. Government will likely maintain the stringent financing environment to temper the demand of houses and weigh down the home prices into 2015. Developers will have to price their project more competitively and double up their marketing efforts to realize sales considering the large supply of houses to hit the market in coming 2 years. Following the slowdown of the residential housing market, the government scaled back the land supply for residential developments on the one first half of 2015 confirmed list of the government land sales program, with 6 residential sites for about 3,020 units houses. This is about 23% lower than the 3,900 units on the second half of 2014 confirmed list. The residential price is still correcting and should only see a price reversal in 2016 onwards. We prefer developers with less residential exposure and have strong organic growth through acquisition or development projects. We maintain buy ratings for Amara Holdings and Cinema Lands and accumulate holdings for Global Logistic Property, Hobby Land, and OUE. With this, we end our market commentaries. For more information, please log on to Poyens and refer to our reports on the companies. With that, I have come to the end of the presentation. Thank you for watching this week's Market Watch. I am Caroline from Phillip Securities Research. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.